Hi guys, we're going to be looking at IAS 8 accounting estimates, changes in accounting estimates, changes in accounting principle. I think that should be the first one, and errors in the preparation of our financial statements. Right now, there are things we should consider very, very. Uh, there are things we should consider, right, when it comes to IAS 8. Now, let me start with accounting principle. Accounting principles. I don't want to bring in grammar. I just want to go straight to the point. What are the accounting principles? So let's say for inventory valuation, for us to be able to value the cost of inventory we have, maybe at the end of any period in time, based on IS 2, uh, for accounting principle, every business can either use weighted average or FIFO, first in, first out. Consistently. Accounting principles are to be applied consistently. With this idea, you might think, what if there is a change in accounting principle? How do we effect the change? Changes in accounting principle, for the fact that they're supposed to be consistently applied, should be applied re- retrospectively. Remember, accounting principles are supposed to be consistently applied. Now, retrospectively means we are in 2025. If it happens that we are making a change to an accounting principle, it should be in a way that it should look like that change did not ever occur. Like we have been using that principle for the first time. For instance, if you are using a weighted average method of valuing our inventory and it happens that we want to change to FIFO, it will look like we have been using FIFO all the while. I'm not going to do much of calculation here. I'm just trying to let us understand the concept behind these assumptions or these principles, right? Now that is for inventory valuation. Now the consistency, please don't get it twisted. Consistency doesn't mean you have to make use of weighted average valuation, inventory valuation method for all your inventories, right? It is saying the consistency is applicable to a specific nature of inventory or class of inventory or PPE. In PPE, we have either you're using revaluation model or cost model. But for inventory, which is IAS 16, then for inventory, which is IAS 2, is that you are using weighted average method of FIFO. LIFO is not recognized by international financial reporting standards, so you're not bringing in LIFO. Now the question is, when should we use weighted average and when should we use FIFO? Weighted average, if you discover that the prices of your inventory usually fluctuates. So weighted average is going to spread that fluctuation, whether it is high or low, whether the prices are going up or going down, whichever, is going to spread it evenly within the quantities or whichever items, the quantities of items you are purchasing. So it's better you use weighted average when it comes to fluctuation in prices. Now, when it comes to items that it depends anyway, or maybe when it comes to maybe production items. So when it comes to items that uh, uh, has expiry date. So let's say for drugs or for some kind of inventory item that has expiry date. Of course, it will be wise for you to make use of FIFO for such measurement valuation of those inventory. So it means first in, first out. Of course, which makes sense. But then your first in, as you are acquiring this inventory, we are ensuring that the expiry date is more than the uh, is it will be nearer than another inventory you are buying in 2 days or 3 days time. So we are assuming that the earliest inventory you purchase has expiry dates closer than the other inventory you purchased later on, right? That's what the assumption is all about. So FIFO, we click in, we clock in. So the first item you bought should be the first item to go out when it comes to issuing to your production center or issuing to the retail or selling as a wholesale to your customer. Now, another way we talked about now when there is a changes, yes, because of this thing, if it is uh, possible, if it is not possible, let's say for instance, you've published your financial statement uh, on Security Exchange, I think NSC, Nigeria Stock Exchange Market for 2024, and in 2025, now this there are reasons why uh, there will be changes in estimate in accounting policy. You cannot just uh, assume you are changing accounting policy. There are two major reasons why accounting policies are changed. Number one is either the um, IFRS, International Financial Reporting Standard. There's an issuance from IFRS to that effect, requesting that changes be made. In that case, that is one option. Second option, the company can decide that it is better, it represents fairly, faithfully the transactions that have occurred. Is better, is relevant and reliable. It will bring relevant and reliable information if we change the accounting policy. Those two options. So it's either an issuance from IFRS or the management can decide to change the accounting policy, right? Now, another way, in these two instances, whether it is IFRS or you as a business, you decide to change the accounting policy. Someone might ask, why should we change accounting policy? You might be using weighted average and you discover that the inventory item you're not using now are no longer, because in fact the reason for the consistency actually is because of comparability. Remember, accounting financial statements or annual reports are always having comparable figures for different years. So for you to be able to uh, faithfully compare the figure for an inventory in year one to year two, year three, year four back, it's better you use that is achievable and faithful when they are used when you use a particular inventory valuation method. So can I just decide I want to use weighted average year one, year two, use FIFO, year three, weighted average. That is inconsistency. So you are it's not fair because you are using a weighted average method of valuation against a FIFO method of inventory valuation. So it's better for you to make it stick to one or any of the two. Now, either of the two, when is either there's an IFRS issuance or the management decide. If either of the two, we are going to adjust retrospectively. So we are going to go back, maybe change the retained earning for each of the period, make adjustment prior to whatever possible. Now, if it is impracticable, just like I've said earlier, in these two cases, whether it is an insurance from IFRS or it is a management that decides to change the accounting policy, if it is impracticable, I think I should write that, impracticable to do this, you should use the earlier possible period that you can make adjustments. So for instance, I am a public company and I have listed my what is it called? I've listed my financial statements on the stock exchange market and I have made some changes in accounting policy in 2025. I have my 2024 report already circulating for everybody's consumption. So it is allowed for me. If I'm seeing this as my own impracticability, that at least the most possible extent that I can go is from January to now, right? January to now. At least we still have these transactions and they have not been posted. Now, if I'm to adjust, even though if it is possible for me to adjust, there's always a there's it is always required for disclosure. It's better, it's always for transparency. A disclosure. You're going to disclose in your financial statement that there was a changes in accounting policy, by what value, the reason why you are changing it, and why you think it should not. Yes, why you think is better for you to change it. What effect does it have? So that the users of your financial statement can be well informed to make better decisions. We've said a lot actually. Now this is inventory valuation. Now for measurements, yeah, we'll talk about cost model or cost model. This is where you have the historical cost of your equipment. So even though you bought your equipment 20 million since 10 years ago, it's still going to be showing 20 million. Then the accumulated depreciation, then like that. But if you are using revaluation model, like the land that we are saying, land hardly depreciates, right? Like the land we are saying, revaluation model is better. Now I'll come back. So it means I can use weighted average for some specific nature of inventory and FIFO for specific nature of inventory. Then similarly, I can use cost model for specific nature of PPE, like land, I have property plant. Plant, plant and machineries, right? Motor vehicles, office equipment, and the rest. Yeah. Then we can now use the revaluation model for my land. Now, consistently. So it doesn't mean I have to use revaluation model for all my PPE. That is not the question. It doesn't mean I should use weighted average for all my inventory. You can use this different method for different classes of equipment or inventory consistently. Don't forget disclosure. This is where everything will settle. Because if I'm comparing year one to year two and I'm seeing some differences I don't feel like I'm not comfortable about, I should be able to see a disclosure, a reason to make me understand as to why such adjustment or such variance occur. Right? Now, there are also instances where you don't, which are not recognized as, which are not classified as changes in accounting policy. What are those instances? So let's say, for instance, you are into real estate or you're into investment property, and actually you've not been using IAS 40 for investment property, and you now get to understand that IAS 40, all of a sudden, you now go to say IAS 40 allows for fair value representation, fair value or cost for my properties, for my investment properties that I have. Then I decided that okay, I want to start using IAS 40. That is not changes in accounting policy. Yeah. This is first time adoption of the accounting policy. Or you have been spending advert advertisement expense of, let's use Nigeria here, let's say 20,000, 10,000, 100,000, 20,000, 10,000, 50,000. This is what you've been spending under your advertisement or public relation, I don't understand, but whichever, you've been spending this kind of value. But all of a sudden, boom, you started spending like 10 million or 20 million for this same advert, and you decided to use IAS 38 because it's looking big, intangible asset, if I'm not mistaken. So I decided to start using IAS 38. This is not this is not, what is it called? This is not changes in accounting policy. Before I forget, now in the case where IFRS issued the a standard that warrants you to change your accounting policy, in that case, they will give what they call a transition process. Transition, sometimes transition procedure. This is like a manual on how you should carry out the changes. In the case where this provision is made, we are going to we are going to strictly adhere to the procedures that are embedded in this transition uh, what is it called, procedure that was provided by the IAS board, or by this IFRS. In that case, there's no need for retrospective changes. Just, just remember, I said, let me bring the point. I think that should be all for now for accounting policy. What about accounting estimates? Accounting estimate, you might decide that, okay, for my motor vehicle, I'll be using this motor vehicle for, let's say, 10 years. For 10 years. But when you are in the third year through using this motor vehicle, you discover that because of the rate of depreciation, maybe the maintenance cost, or the way you are spending money to repair, or the way the motor vehicle is performing, because it's an estimate, and it is required for you to make an estimate because of these are expense that are expenditure, that are asset related, that you've recorded in your balance sheet, in your financial position. So during the third year, you discover that, oh, this thing cannot go extra 7 years. Let's say it might go above or below. Now, this information came in as a result of the new information. These changes came in as a result of the new information, the present circumstantial information you just got. So the changes will now be the remaining 7 years depreciation will be adjusted in such a way. Let's say at the end of the day, you discover that it's going to take you 6 years, not 10 years. That 7 years depreciation, remaining amount for the depreciation, will be adjusted in such a way that it would, what is it called? It will fit into the remaining 3 years. In addition to our inventory valuation and measurement, there's also depreciation. So in depreciation, is either you're using reducing balancing method or straight line method. I'm just trying to, as I remember, I'll just try to chip it in. So for those estimates, what you should do, the changes should be done prospectively from the instance where the information has been provided. Thirdly, let's go to error. Now, for error might come as a result intentional or fraud. So let's say for unintentional error. So let's say you purchase an asset worth of 3 million in 2024, and now we are in 2025. You discover that this particular amount is missing in your financials. You can make that adjustment. Just enter. That's error. Or error can come from calculation, wrong calculation, computation. You can also just make that adjustment instantly, right? Or if it is fraud, you are just discovering. So all those are just you are just effecting you are just correcting it. And if it is fraud, maybe you charge the person who is responsible, and all those things. You just get the idea about that. So this is uh the idea behind accounting principle, changes in accounting principle, changes in estimates, and also change errors based on what IAS. There are a lot of things you can actually understand when it comes to the practicability of this IAS 8 standard. If you have a contribution or addition to this I've said, you can also drop it on the comment section. If you like my videos, don't forget to like, share with your friends, those who might also be interested, and don't forget to subscribe to my YouTube channel. And if you also have an idea, also please don't forget to drop that on the comment section. Or if you have any instance you want me to also demonstrate on, I'll be gladly, I'll be happy to do that. See you guys in my next section.